Welcome to week 2 of ACC 100. Yay! I know it's going to be an excited week, guys, and I can't wait for us to just get through this material and all be expert accountants. This week, I kind of decided to do something a little bit different. I'm going to be going through chapter 4, which is completing the accounting cycle. It'll be like a good demonstration problem that will help with your homework. I just kind of want to quickly go over our responsibilities for this week. We got to post to the discussion. We need at least one post by Thursday, 2 by Saturday. When you're doing your discussions, especially at least one of your discussions, make sure it's almost in an essay type format. You're clear. You're making sure you're answering what the discussion question is. Other things that are due, we know homework 2 is due, as well as quiz 1. Yay! Anyways, let's get started. So this is just a copy of the unadjusted trial balances. So this is the trial balance without making any adjustments. This is the adjustments we're going to be making, which is A, B, C, D, and E. A is unearned revenue, still unearned at December 31st for $4,000. We know that unearned revenue balance was $12,000. So we have to change that unearned revenue balance to go from $12,000 to $4,000. So that means that throughout the course of the year, we've managed to now earn $8,000 of revenue. Prepaid rent, it has a starting balance of $5,000, and this says that we still have $3,000 that's still prepaid at the end of the year. So we know that we have $2,000 of rental expense now because it's no longer prepaid. We've been in that space. We're in there. We have rental expense now. Also, office supplies used. Office supplies is one of those weird things. When you actually buy office supplies, it's an asset. We do not expense it at all until you actually use it. So we know at the end of the year we should have $2,000 of office expense because we've actually utilized that. We have depreciation of $500 and we have accrued salaries expense of $900. This example, we're going to be walking through all the requirements listed below, so just take a good look at the requirements. All of these, it's just taking the unadjusted trial balance and putting them into T accounts. So on the unadjusted trial balance, we know we had cash for $18,000 as a debit. So you see the T account cash is with a balance $18,000 in the debit column, and we have it for all the accounts. This now shows what the unadjusted trial balance was, and then the adjustments that we talked about, the A through E, the unearned revenue, prepaid rent, and etc. And then when you have to add the adjustments, put them together to the unadjusted trial balance, and you get the adjusted trial balance. So for example, the prepaid rent, we know we had $5,000 of prepaid rent in the unadjusted. It's a debit. We're going to lower that prepaid rent because we've been in that space for some time now, and now we have $2,000 of expense that has actually occurred. So now at the end of the year, we still have $3,000 that we prepaid that will go into an expense in the following years. So you can see the debit $5,000, the credit is $2,000, $5,000 minus $2,000 because one's a debit and one's a credit becomes a debit of $3,000. The next slide, we're actually going to go through all the individual adjustments. From the adjusted trial balance, you're going to come up with your income statement and your balance sheet. And you can see how it's just see how the numbers are adding up across the unadjusted plus the adjustments, the adjusted trial balance, and then the income statement and the balance sheet is coming from the adjusted trial balance. So, one, unearned revenue still at unearned December 31st, 4,000. So, we know the unearned balance at the beginning, it was $12,000. How do you get to $4,000? You have to debit for 8,000. So 12,000 minus 8,000 will give you the 4,000 of unearned revenue. And also, now that we've actually earned the revenue, we know we have to make an adjustment to actual service revenue. So service revenue, we had a beginning balance of $27,100. When we add the 8,000 of service revenue now that we have now earned, the new service revenue that balance is $35,100 credit, because we all know that revenue is credit, right, guys? B, prepaid rent still in force, 3,000. So we know the beginning balance. Look at the prepaid rent. It was 5,000. $2,000 of $2,000 of expense, basically. So we're reducing that prepaid rent asset to 3,000, because at the end of the year we only have prepaid that's left over is only 3,000, because we've utilized 2,000 of it, and that is why we now have 2,000 of rent expense. Office supplies. We had office supplies initially of 3,000. We used 2,000. Remember, as I said before, when we use the office supplies, that's when it becomes an expense. So because we started off with 3,000 and we used 2,000, we have 1,000 that we haven't used, right? So that's the new office supplies balance. And the supplies expense becomes 2,000 debit, because we know that expenses are debit. And that is because, well, as I've probably stated too many times, because we've used 2,000 of office supplies. When you use the office supplies is when you can expense it. We have depreciation of 500. We already had accumulated depreciation throughout the years of equipment of 6,500. We're adding another 500. It seems like we get 500 of depreciation each year. So now accumulated, so all the depreciation we've taken over the years is now a new balance of 7,000, and we have 500 of depreciation expense for the year. Accrued salaries expense is 900, so obviously it was near the end of the year. You and I didn't receive a paycheck. So we have salaries payable because no one got a paycheck of 900. We had a beginning salaries expense of 5,500 already, because we want to be regularly paid. We wouldn't want the company to have a big salaries expense coming kind of at the end. So we're adding the 900, that little bit towards the end of the year that we didn't get a chance to pay out. And so that salaries expense goes from 5,500 to 6,400 because of the 900 that we kind of owe towards the end of the year. And now this is the adjusted trial balance, which we've kind of seen previously. This is the new adjusted income statement, again, with all our adjustments. And we are kind of going to go through the statement of retained earnings. So we know retained earnings from the unadjusted trial balance was 10,000. We got 24,200 of net income for the year. We can see that on the previous page right here. Then we paid out dividends of 7,100. That was actually on the unadjusted trial balance. So 10,000 plus the 24,200 is 34,200, and we're actually gonna subtract the dividends because we're paying out the dividends to the people that own the company. So we're taking that money out of the business. We're not, in other words, we're not retaining that income because we've paid it out. And what we've now actually retained is 27,100. The next couple of slides is kind of going to go through the journal entries because we haven't kind of done that before. The journal entries of how to get to the 27,100. We all know that income statement is basically a point in time, right? It's just a point in time. Like you only hear income for 1 year. So at the end of every year, we close out the income statement to the retained earnings. We make it zero and then start over again from scratch. And we know balance sheet is like something, it's like forever. It's just where you are for at a point in time, but it's accumulating everything all throughout the years. So we see the retained earnings for the 27,100. We're going to go through it. So we know before we had service revenue, it was a credit because revenue is a credit. So how do you zero out that revenue? You debit it. So we're debiting the service revenue for 35,100, and we're putting it to something called income summary. So you see income summary now has a credit of 35,100. Then we're looking at all the expense. If you add up the salaries expense, the rent expense, the depreciation expense, the supplies expense, it all equals 10,900. Those expenses were all closing out. We know previously they were all debits because expenses are debits, right? So to close it out, zero it out, we have to credit it, and then we debit income summary. So here, if we look at just the T account for income summary, we have the 35,100, that's the revenue, and the expenses of 10,900. We have a balance of 24,200. We're going to take that 24,200 debit balance, and we're actually going to now close the income summary to retained earnings. So that's how we take it from the income statement, because we're zeroing out the income statement and we're actually bringing it to retained earnings. Then we're actually going to make a journal entry for the dividends, and we know the dividends is going to reduce the retained earnings. That's why it's a debit. And when you looked at the retained earnings, you see now how it gets to that new balance of the 27,100 that we saw previously. Another thing we're kind of going to talk about is just the current ratio. The current ratio is just a good way to say, do I have enough assets to cover my liabilities? But it's talking about your current assets to cover your current liabilities. So our current assets we can see from here are cash, accounts receivable, prepaid rent, and office supplies. And our total current liabilities are accounts payable, salaries payable, and unearned revenue. So our current ratio is actually 2.1, so we know our current assets can cover our current liabilities 2 to 1. I hope you guys got a lot from this. Can't wait for week 3. Let me know if you have any questions. Have a great week.